Hello everyone and welcome back to the channel. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeeze dynamics. We'll be focusing on a specific microcap company that has appeared on our screeners due to its exceptionally high cost to borrow, NCT Limited, ticker NCT. This is a stock showing some truly unique characteristics in the current market. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight to it. NCT Limited, or NCT, operates in the industrial/marine shipping sector. Through its subsidiaries, NCT provides maritime shipping services in Hong Kong and internationally, offering time charter and vessel management services worldwide. Interestingly, the company is also involved in the processing of pulp, paper, and paperboard products. As a microcap company, NCT can be particularly volatile, and its small size often means liquidity can be limited. Jojo NCT price action. Looking at recent price action, NCT has seen significant movement today. The stock is up plus 5.0%. Over the last 5 days it has climbed plus 15.7%, and looking back 30 days, NCT has surged an impressive plus 45.83%. Volume has also been notable, with today's volume hitting 1,410,400 shares compared to its 30-day average of 1,215,363 shares, giving it a relative volume of 1.2x average. This means more shares than usual are trading hands, indicating increased investor interest. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important for understanding a potential short squeeze? Simply put, the cost to borrow fee is an annualized interest rate that a short seller must pay to borrow shares of a stock. When you short a stock, you're essentially borrowing shares from someone else, selling them immediately and hoping to buy them back later at a lower price to return to the lender, profiting from the difference. This borrowing isn't free. The CTB fee is a charge based on the value of the shares being borrowed, paid daily or monthly, and expressed as an annualized percentage. Why can it exceed 100%? Because it reflects supply and demand. If a stock is highly sought after by short sellers, or if there's very little supply of shares available to lend, the cost to borrow can skyrocket. A high CTB indicates that a stock is hard to borrow, signifying either intense shorting interest or, more often, a scarcity of shares available in the lending market. Why this stock is hard to borrow right now? Now, let's apply this to NCT. Our screeners flagged NCT Limited because its cost to borrow fee is an astonishing 677.5% annualized. Highlight CTB number prominently. That means a short seller holding a position in NCT for a full year would theoretically pay nearly 7 times the stock's value in fees alone. That's an extremely high cost to maintain a short position, and it's a key reason why this stock is considered hard to borrow. The estimated float for NCT is also remarkably small, at just 0.3 million shares. A tiny float like this means that even a relatively small amount of short interest can quickly consume the available shares, driving up borrow rates. While the exact number of shares currently available to borrow is unknown, the 677.5% CTB strongly suggests that supply is extremely tight. Our internal composite squeeze score for NCT sits at 42.5 out of 100. This score indicates that some of the factors we look for in a potential squeeze, like high CTB and a small float, are present, but it's not signaling an imminent, guaranteed squeeze. It's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Squeeze mechanics explained. So, how does a short squeeze actually work? Imagine short sellers have borrowed and sold many shares of NCT, betting the price will fall. But what if the price starts to rise instead, as we've seen over the last 30 days for NCT? As the stock climbs, these short sellers begin to lose money on their positions. Simultaneously, that 677.5% cost to borrow fee is eating into their capital every single day. At some point, the losses and the borrowing cost become too great to bear. Short sellers are then forced to cover or close out their positions. To do this, they must buy back the shares they originally borrowed. This forced buying pressure adds demand to the market, pushing the stock price even higher. This creates a feedback loop. A rising price forces more short sellers to cover, which pushes the price up further, forcing even more short sellers to cover. When the supply of borrowable shares is also shrinking, as implied by a NCT high CTB, it becomes even harder and more expensive for short sellers who maintain their positions, fueling this buying frenzy. Dilution risk check. A critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can be done through offerings like S-1, S-3, or 424B filings. For NCT, we found no recent dilutive SEC filings in the last 90 days, nor any recent reverse splits. This is a positive sign for a short squeeze thesis. Why does dilution matter? Because new shares flood the market, increasing the supply. This can directly offset or negate the buying pressure from short covering, making it easier for short sellers to find shares to cover, or even to establish new short positions. In essence, dilution increases the float and dilutes the impact of short covering. Since NCT currently shows no such filings, this specific risk factor appears to be absent, which is supportive for any squeeze potential. Again, let's pause for an important reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For a stock like NCT with a 677.5% cost to borrow and a tiny 0.3 million share float, what should you watch for? Firstly, keep an eye on the borrow rate itself. Is it staying elevated, or even rising further? This would indicate continued scarcity or high demand. Secondly, monitor the available shares to borrow. If data becomes available, a shrinking supply is a major squeeze indicator. Thirdly, observe the price action. While NCT has seen significant gains of plus 45.83% over the last 30 days, continued upward momentum is key. Lastly, volume. NCT 1.2x relative volume today is a good start, but sustained high volume, especially on green days, can signal strong buyer interest and pressure on short sellers. Show NCT chart, highlight recent price surge and volume bars. Intercont Cayman Limited, NCT, presents a fascinating case study with its staggering 677.5% cost to borrow and incredibly tight 0.3 million share float. While these factors put it firmly on the hard-to-borrow list, remember that high fees don't automatically guarantee a squeeze. It does, however, create an extremely challenging and expensive environment for anyone holding a short position. This educational example highlights the unique dynamics at play in the micro-cap space when borrow fees go parabolic. Keep learning, keep researching, and always stay informed. If you found this breakdown of NCT and short squeeze mechanics helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments below what other stocks you'd like us to cover. We love hearing from you.